Here we go. All right. People should trickle in a bit. They're already there. Welcome, everybody. I am wearing a jacket and I have been played because if you've been to any of our webinars before, Stephen has something called 3-Piece Thursdays, which the first year I knew Stephen, I only met him on Thursdays, so I didn't know this was a thing. And so I wore a jacket today because it was going to be a Monday and I expected him to roll up here in a hoodie and me be like, here is me giving back to you. But Stephen, why are you wearing a jacket today?
Well, Ryan, I'm out here in San Francisco for the next 6 weeks, raising our Series A. So we're raising an $8 million Series A here at Forecaster. And I normally wear a 3-piece suit every Thursday, but when I'm fundraising, every day is Thursday. So wearing a 3-piece suit every day for the next 6 weeks. I'm on day 11 here. So
awesome. And what a segue into our topic today, which is fundraising and using your financial model for it. And right now, like you said, you're using the Series A. We've looped this into our founder series programming, all about launching a company, literally going from 0 to 1, getting incorporated to getting the initial stock grants out, starting those relationships, starting that momentum, and possibly getting in early money. Now, every company is different. The kinds of rounds you raise and when, whether it's seed or pre-seed, or you put your own money in, or friends and family, or straight to something bigger, will change based on your market, your experience, your network, your industry. Capital intensive industries go very different than just scrappy startups, but the principles are the same. And a financial model and financial projections are going to come up no matter what. Your uncle might not ask for it if it's a friends and family round, but chances are if you get any kind of professional investors into your company, they're going to ask about your financial projections. And a lot of the conversation outside of the sizzle, outside of the 2-minute pitch or the elevator pitch, when they like you, they like the market, they think there's something there. Once conversations get serious, a lot of it is going to circle around the financial model. Where can this company go? How can this company perform? Does this company make sense for my portfolio as a private investor? And we have the forecaster team today. Stephen, usually we work with Logan, but Stephen's here today due to a calendar issue. But I'm super excited. He's going to run through finances for fundraising and kind of what to think about, not just in putting the model together, but to how to handle the entire life cycle of talking with investors around your financial model. As always, yes, we're recording this. Yes, we will distribute it out. There will be a recording sent probably tomorrow. We'll give you the materials. Forecaster is a generous discount if you're at that right stage for their product, and we'll post that stuff in chat. I believe I opened up the chat, so feel free to say hi, where you're from, where your startup is, but no pitching. We're all about learning here and connecting and sharing experiences. And that's it. I think I got through everything. So without further ado, Stephen, please introduce yourself. We also have Calvin here from the team. He's going to help with some of the Q&A. I might splice in some questions if they're super relevant, and we'll definitely have some time at the end. And let's do it.
right on. Well, I appreciate that intro, Ryan. And yeah, I'll tell you guys a little bit about myself as we get going here as well. But I think you're totally right. Like, I mean, it's kind of crazy now, but I mean, we've had the fortune of working with we got over 550 companies using Forecaster as a financial model, and we'll get into a little bit about what our company is. But like we've been able to work with a lot of companies on financial models at kind of all stages, like pre-seed, seed, Series A, beyond, and the financial aspect of the business really does like carry a lot of weight in a fundraising environment, and like we've really seen it materially move the conversion rate, of getting like an interested investor. Like you said, like you start with that sizzle, you start with like selling on the vision and the execution and the strength of the team, but like converting that interest into a check, a model is like a really great way to do that. So I'm pretty stoked to be here with you guys and talking a little bit about that today. I'm going to go ahead and share my screen here and just pull up the presentation, and we'll get going, because we got a lot of ground to cover, and I know we got an hour. So and I'm sure if you guys' calendars anything like mine, it's probably pretty stacked. So we're gonna get you in and out here. But that's really what we're focused on today, is like talking about how do we leverage a financial model to ultimately like drive conversion with investors? Like how do we use like our own understanding about the financial underpinnings of our business to essentially just close an investor, to like get an investor to actually write us a check? So that's what we're going to be focused on today. And like Ryan said, my amazing co-founder Logan usually is here kind of working with Gus and doing these webinars. I get the honor today, so I'm really excited about it. We love working with Gus. And so a little bit about me. I'm a multi-time founder, so I've started 2 companies. I've taken them both through Techstars. I've raised, this slide I need to update, probably a little bit more than 8 million in venture capital to date. So more than some, less than others for sure. And in between my 2 startup companies, built a lot of financial models. I was the head of finance fractionally for about a dozen startups. So I've done a lot of work in the startup finance game. I've helped a lot of companies raise money as a fractional head of finance, but I've also been in the founder seat. You know, I've raised 2 pre-seed rounds across my 2 companies, 2 seed rounds. I'm now raising a Series A for Forecaster right now. So I've had the chance to kind of live and breathe, you know, a lot of the stuff that we're going to talk about. And so hopefully you get a lot of value out of it. And that's a little bit about me. As far as Forecaster, you know, and like Ryan mentioned, we love working with guest companies, and we've got about 100, you know, companies that have come on and used Forecaster as a financial model through Gus, which is really awesome. We're really stoked about it. Forecaster is an alternative to Microsoft Excel when it comes to like building and managing a financial model for your company. And I think about it kind of like putting your model on rails. Like it's a lot more standardized. It's plugged up to your accounting. It's a lot more visual. I think it sells a lot better with investors. It just really provides like a lot of rigor. And we actually do a lot of human support. So we pair everybody up with an analyst to do a 30-day white glove onboarding, make sure you get like the best possible model. It's going to work well with investors. So Calvin can throw a link down in the chat where if you're interested in Forecaster, you can get in contact with us and you can work with us. We'd be thrilled, you know, to entertain the opportunity to work with you. But I want to be really, really careful to also say this, like Ryan said, like we're not here to sell you on Forecaster. We're not here to try to get you to become a customer of Forecaster. Like we're here to educate. We're here to learn. So we're here to just going to really focus on talking about like, first of all, what is a model? Like just getting really crystal on, you know, what is a financial model and how do we use it? How does it come up in a fundraising environment? And then we're going to spend a little bit of time, you know, in the classroom here. So like, how do you use your model in a pitch deck? I think everybody's is very familiar probably with a pitch deck and that kind of thing. Like, should your model be in the deck? How do you use it? Then we'll actually jump into what I think is the most important aspect, which is how do you actually present your financial model to investors? Financial models are much more powerful when they're presented by the founder rather than if they're shared, you know, with an investor at a context. So we're going to talk about that. And then I think the best part of today really is like, we're going to jump out of the classroom. You know, I'm literally out here in San Francisco raising a Series A. Like it's got stuff couldn't be any more fresh. I've been, you know, presenting our financial model to investors a lot over the past few weeks. So we're just going to look at our live example. Like I'll show you my actual Series A deck that we're using, how we use the model in it. Like I'll walk you through our financial model. And we did this the same way for the pre-seed and the seed stage as well. So just like Ryan said, it really does. It applies at every stage. It's actually even more important at those early stages in terms of like the throughput you can get. At the Series A, it's kind of expected of me that I have this model and I can walk through it, so I don't get as many brownie points for it. At the pre-seed and seed stage, you get a lot more of those brownie points if you can really do this stuff. It's something that not every founder can do well. So if you can do it well, you're going to really see a big return on investment. So
I think that marries super well with the ethos we preach together at Gus is like, a little bit of ounce of prevention is worth a pound of cure. If you get your ducks in a row, like Gus launches a product just like this, where it's like, once somebody is interested in something, if you can literally dump the kitchen sink on them and how prepared you are, it's not just like, oh, I might be interested in learning more. And you're like, oh, wait, I haven't incorporated yet. And let me go get my agreements in place and let me go do this. That just completely takes the energy out of the conversation. But if an investor says, huh, this is interesting, like, how are you going to grow this? And you can be like, boom, here's my financial model. Boom, here's my entire like diligence ready thing. At every level, you can really reduce that friction.
Yeah, I completely agree with that. And I've seen that pay dividends for me in my own career on both of those sides. So what is a financial model? You know, that's what we'll just quickly get on the same page about first. And we think of a financial model as essentially a business simulator. So the purpose of a model is essentially just to simulate your business into the future. It's to kind of allow you to take the business on a virtual test track, right? So you can kind of take the business on a virtual test track. You can essentially see how the business performs in a variety of environments, you know, without having to actually spend all the time, money, and effort like building the company. And I think this is, of course, very interesting for us as founders to try to like get a look into the future and say, hey, like, is this a business worth building? How much money, you know, is it going to take for me to build this business, and what should my milestones be? You know, but for fundraising, like it's going to answer a lot of questions that investors are going to naturally have about your business, and it's going to allow you to essentially like put the investor in the car next to you and like take them on the virtual test track. Like any investor is investing in essentially in the future state of your business. They're not really investing in the business today. They're trying to look forward and say, hey, like, what is this business going to become in the future? And is that really interesting? And is this the team that can get it done? So should I make the investment? And so you really want to paint that picture. And your pitch deck paints the picture in a way, right? It tells your vision and your go-to-market and how you're going to scale the company. But your model should ultimately tell that same story. It should really tell kind of a numerical narrative, for the company. And so it's going to answer a lot of these questions, which I imagine, you'll be asking yourself to kind of get ready to raise the round, but your investors will ask as well. And if you can answer them kind of in a language that makes sense for them, like in a financial language, it tends to resonate really well. It tends to drive conversion. So, you may ask yourself how much money you should raise. You can use the model to dictate kind of, okay, how much money should you raise? I'm raising 8 million, not because I thought that sounded nice, but because I wanted to hit certain milestones with the company. And I thought that I needed to hire a certain amount of people to do that. And so I look at the next few years and see how much additional capital do we need here at Forecaster to actually get that done. The model actually said we needed 6. But Logan and I, being finance guys, we want to apply a buffer to that. We want to apply a buffer of 25% and go out and seek 8 so that we make sure that we have some conservatism baked into the model. So, you can use the model to tell you how much money you should raise. And then an investor is going to ask you that. And rather than saying, well, $1 million just sounded like a nice, easy number, and that was what my friend raised, you can say, hey, like, we're raising $1 million because we want to reach these milestones. And in order to do that, we need to hire these people. And this is the amount of capital that we need to hit those milestones. So it just allows you to kind of provide a lot of rigor behind, your answers as to like how you're going to spend the money, what the milestones are going to be, how you're going to get there, how you're going to acquire customers, what kind of metrics you need to hit in order to achieve your goals. Yeah, it really just kind of provides a framework through which you can answer questions and have discussion. And we're going to see how we do that here in a minute when we talk about like how you present a model to investors. Now, one thing I hit on, which is totally true, but so we'll just hit on it real quick again, is that like, if you are raising a pre-seed or a seed round for your company, this is a lot even more impactful. In some ways, it's less expected of you. Like me at a Series A stage, I mean, me especially, I'm running a financial modeling company, but even if I wasn't, like, it would be very much expected of me that I have a model. It's kind of table stakes. If I present it really well and it's a really good model, then it's kind of a bend in my favor. But at the earlier stages, it's less ubiquitous. And so it's more of an opportunity. Like fundraising, for any that haven't done it, and for any that have, you'll get this right away. It's extremely competitive. It's a really difficult thing to do. Investors have to say no a lot more than they say yes. So it's a really tight funnel, and you need to kind of find any way you can separate yourself from the pack. So having a great model, being able to present it, it just absolutely will separate you from, the 99 other founders out there seeking like the same investment dollar. And I think especially in a market like this, like, you got to do everything you can to separate yourself, especially controllable things, right? Anything that's controllable, like Ryan said, like being squeaky clean, putting that data room together on the front end, having all your diligence, checked, that's controllable. You got to do that to go into the raise and like optimize your chances. Having something like a model put together and being able to present it, that's totally within your control. You don't have to rely on anyone else to get that done. So like, you really should kind of, make the time for that. It'll pay really big dividends for you, especially at those earlier stages. So, okay, so that's kind of, some setup stuff there. Now let's kind of get into, the main 2 pieces of it. The first piece is like, how should the model be represented in the pitch deck? Like, you have a pitch deck where you're going to walk through, in my mind, things like kind of the problem solution and like market opportunity, the vision of the company. You should be walking through kind of the core metrics of proof of execution, your traction. You should be walking through some of the fundamental aspects of the business, like maybe your team or your go-to-market or your kind of a key strategic bets. Now, the model should be represented in the pitch deck, but it should be kind of at the end of the deck, and I'll show you what this looks like for us. But your goal is really just to tease the investor, with financial projections. So most investors are either finance kind of people, like that's their core competency, or at least they're kind of they're financially inclined, and so a lot of investors are going to want to understand that there's some financial rigor behind the company. And your job in the pitch isn't to go deep into the model, really. It's just to communicate to the investor that you have financial rigor behind your company. Like, you've done that kind of legwork and you're prepared to have those conversations in a follow-up meeting. Like, fundraising is really a game of like building trust and confidence. It's about chain linking interactions together. And in that first interaction, that first pitch, your job isn't to really close the investment, it's to set the hook. And so you're going through those fundamental aspects of the business to drive interest. Now, this is a great way to kind of turn that interest into a second meeting. I think a great second meeting for you as a founder is to present a financial forecast like this and to talk to the investor and say, hey, you know what? There's a great financial model behind this forecast. Like, we put a ton of work into understanding how our business works financially and how this business scales. I'd love to spend 45 minutes with you, walking you through our financial model and showing you just how much rigor we have behind this business, because we really know this business back to front. And that communication right there just really drives investor confidence. And it converts into a second meeting. And that's one of the things you should be thinking about in fundraising is, what are those interaction points that you want to chain link together? The more you can control the process, the more you can try to get everyone to follow the same flow, the better chances you're going to have of raising capital. If you in that first meeting with just a, hey, well, think about it and let me know, then it just introduces like a lot of latency into the process, and everybody's just kind of flowing around, and rounds have a tendency to kind of drag on and stall out. But if near the end of the meeting, you're like, hey, so this was great. I really appreciate taking this time with you. I think the best next step would be for us to sit down and do a model walkthrough. Or it doesn't have to be, it could be a product demo, it could be meet your co-founder, it could be a tech review with your CTO, like it could be anything else. But just think about what that next step is, and think about a financial model walkthrough as one of the steps in that chain link to drive investor confidence and ultimately close an investor. So you really just want to put the summarized output of the model in the deck to tease them, because you want them looking at this output, and you want them saying, hey, like, that looks attractive. Like, that looks like a big enough business to be worth my time, but it also looks reasonable. Like, I'm not looking at these numbers and just saying like, okay, give me a break. Like, these are clearly, yeah, like these are like, you're getting to $1 billion valuation faster than Slack did. Like, come on, like, you want them thinking, hey, this looks some of my better performing companies. It looks reasonable, certainly looks attractive, but like, where did you get those numbers? You want them thinking, where did you get those numbers? And that kind of falls right into your hand. That's when you're answering, look, like, I've got a great financial model for the company. We've put a lot of thought into it. We recognize it's a model. It's not a crystal ball, right? It doesn't tell the future, but we put a lot of work into this model, and like, we'd love to spend some time walking you through that model, which is ultimately where pretty much all the value is created, is actually that presentation process.
And I think that's a great point that we get a lot is like that second date or third date, whatever chain link you're on, is like having a direct next step is such a valuable thing for a founder. Because if it's literally like, they're not going to mail you a check the next day being like, I'm totally going to invest in this company, by the way, like, here it is. So it's really, like you said, a couple things like product, depending on the state of your company. But I will say, if you're dealing with professional investors, upside motivation and portfolio fit is probably first and foremost, because it's the easiest thing that they can use to not waste their time. No offense to any kind of founder, but if you literally have a portfolio theory that's like, I need companies that return this X, that have this much market opportunity. Like, if that slide had 2026 as revenue is now 6 million, so it's grown a couple, double-digit % over the next like 6 months, some investors will just be like, that's not for me. Not saying that it's a bad company. There's many different kinds of approaches. Or if that was 500 million, it's also like, well, this person is completely crazy. But syncing it with what they really want as actual next steps, and being prepared to enter into that kind of meeting is, I think, one of the huge game changers in terms of removing friction from a fundraising process.
Yeah, I think that's really well said. And like, the sooner you can like make sure that you're talking to kind of, you're qualifying, and so are they. Like, both sides are qualifying to make sure that like there's enough overlap to kind of get a deal done, like Ryan's talking about, and kind of, plans to scale the company, maybe sector or stage fit, things like that. You want to essentially, get to there as soon as you can, so that you're spending time with folks that would be interested in doing a deal, and vice versa for them. So as far as like how the presentation piece is done, I'll spend just a little bit of time talking about it here, but I think it makes a lot more sense when it's actually done live. So we're going to actually jump into our model, and I'll kind of walk with you guys through it and talk through it. But just a few notes on really how to do this. One is, and this is really important, but it'll seem basic, but it's like, but don't share the model before the meeting. Don't share it in lieu of the meeting, like force the meeting. And I think the same way about decks. I think a big mistake founders make a lot of times is they get asked for the deck, they get asked for the model, they recognize that everybody's busy, so they're just sharing this stuff out. They're not sitting down, they're not walking investors through it. And I think that you lose a lot of leverage when you do that, because people are just people, and when they consume information, they form opinions. And once they form an opinion, they're usually pretty stubborn about it. So like, you want to be in the room when they're forming that opinion so that you can control it, so that you can bend it to your will. You can see the body language, you can overcome objections. Like, you really want to be in the room when this information is landing for the first time. And so I think whenever you can afford to do it, which is most times, like, I think you should just kind of politely push back on this stuff. I really don't think it's within your best interest to share a deck in advance of presenting a deck, or to share a model in advance of presenting a model. I think you should present the model. I think you should walk through the model and then share a version with them after the meeting. So just really kind of take that to heart, I think, and make sure you actually are kind of trying to position yourself around having live time with the investor, because that's where the confidence and trust is built. And then in the meeting, and we'll see this when I go through it, it's not about kind of going really deep and into the weeds or anything like that. You really want to be having like a high level strategic conversation, and it should be much more of a conversation, less of a presentation, really. And you want to kind of just be in control of the process. Like, you should go in with an intentional approach of what you're going to walk the investor through. You should be flexible, because like, you're there to drive investor confidence and trust. And so whatever their concerns are, you're going to want to go deep. You're going to want to talk about those concerns, because that's how you're going to get them to invest. So you got to be flexible with it, but you should be in control. Like, you should show up to the meeting on time. You should have an agenda for the meeting. You should have a game plan of how you're going to walk it through. And we'll see that in just a sec. But just be thinking that like, your goal isn't to get down into the weeds, that you're only going to go down to the weeds if an investor drives you there. Your goal is to be high level, strategic thinking, strategic conversation, alleviate concerns, reduce risk. Like, that's kind of the theme we're looking for here. And then after the meeting, just always follow up, like, try to really always have a next step identified in the meeting, even if it's just they're going to talk about the investment opportunity on their next Monday investment committee meeting and get back to you on Tuesday. Just like, try to make sure that you have kind of a timeline attached to it, a next step attached to it, so that you can follow up aggressively and like keep folks moving through the process, so that you don't kind of end up in that like email purgatory. So, okay, so let's see. So we got 23 here. So perfect. Let's just get into the examples here. So let me switch gears. Let me first pull up our deck. So I got this pulled up here. So this is our Series A deck. Like I said, we did the same thing kind of in the seed deck as well. So just to flip through it though, we have like market opportunity. So leading with like, here's the kind of the size of the prize and the problem that we're solving for. Here is our vision. Like, we want to be an operating system for FP&A. We're producing a large proprietary data set. So kind of vision, value. Here's how we're like these other mammoth companies. Like, we're going to be big too. Like, the intentionality behind our business model, the traction metrics that we've achieved, why I think we're going to win. So we talk about competition and emotive partners, like our partnership with Gus, which is very, very precious to us. Like, like a human approach, like we're hitting on most of these kind of core elements, but then you see just before the ask, just before I get to, hey, we're seeking $8 million to become the default operating system for FP&A, I flash the forecast. Now, for me, I flash, a screenshot of Forecaster. So, which is kind of cool for me as a company, because I can say, hey, this is our product and also our model, but this works really great. You just kind of have a nice summarized income statement here for folks. And what I like about a summarized income statement is they're going to look at the revenue line. That's ultimately what they're going to care about the most. If you have historical data, I like including it, because I can quickly tell the investor, look, like, we 4x'd our revenue year over year. We're planning on 2 to 3x them for the next 5 years to become a pretty, meaningful company. So I can quickly kind of communicate that to them. They can quickly see, that like, I've baked in the cost of InterScale, like, we're going to lose money for the next 3 years. I may include for them a statement like, now, if we wanted to become profitable, like we could become profitable sooner, like we have plans for that as well, but we're anticipating, venture scale, and this is a competitive space. So we're levering the company up, and losing money for the next 3 years. So you can have conversations around that. But just like a nice, summarized income statement goes a really long way here. And then I'm just mentioning to investors, there's a lot of meat behind this model. Like, and I would love to spend 45 minutes walking through our financial model and showing you like how we came up with this forecast, what our milestones are, what our hiring plan looks like, et cetera. I really want you to understand this business, as well as I do. So that's I think a really powerful way to do it, and then it's always good to kind of end with the ask. And when you make an ask, by the way, just one thing, it's not really about fundraising, but I think it's still really important, is make it about milestones. Like, you're raising money not to hire people. You're raising money not to get runway for the company. You're raising money to reach milestones. And in order to reach those milestones, you need people, you need time, but those are resources. You're not raising money for that. You're raising money to acquire customers. You're raising money to hit a revenue goal. You're raising money to drive one of your most important metrics. So make it more outcomes based, and that'll hit a little bit better with your investors. Okay, so this is the deck side. And so then, I do this, I get them excited, in that first meeting, and they make the decision to take that next step with me and schedule that second meeting. So then I'm going to switch over here into
I'll preface this with a question we had privately from Melissa McInnes, but was specifically my domain. It's like, on Gust, we ask for your pitch deck, and we ask for like 5 years of financials, just 5 years of top line yearly financials to apply to angel groups. And she was asking, well, why does Gust ask for that if you shouldn't lead with your model? And that's the separation point, where if you're pitching to angel groups, like, it's okay to put a 5-year plan in your pitch deck that you're likely going to be presenting to the group, if you get a chance to do that. But what what Stephen was talking about, see, look at how trained I am, was the detailed model, where it's like, if you share with somebody like, by 2026, we're going to have $80 million in revenue, they can't say, unless it's so high or so low that it's ridiculous, they can't say like, yeah, but I don't believe that your paid marketing is going to pay off that way, or I don't believe you'll be able to hire fast enough to like hit those operation costs, or anything like that. Those are the things that you want to not encourage without you being there. And that's the details of the model. Excuse me. So we ask for kind of the table stakes on the Gust profile when using your profile as a common application to angel groups, because they will all ask for those rough kind of things in order to even see if they want to screen you and put you in front of them. But it's the deeper dive ones you don't want to put your detailed model as like a document that you send over without even meeting a person.
Yeah, I think that's well said. And honestly, really, I mean, in reality, the same thing happens with the deck as well. Like I have basically like an intro deck, like a teaser deck, because, to Ryan's point, even on the deck side, like there are a lot of people that they just want to get a sense of the company before they meet. And so I have like an intro deck or a teaser deck that just kind of hit some of the really high points that I think there's really nothing to pick at, points that I think are just only going to be positive and kind of increase my chances of getting conversion. And then I'll leave like the full deck to present. But angel groups are a good example of folks that do kind of want decks and stuff on the front end. Some investors will as well. And so I kind of speak from a purist sense on it, but just like, yeah, I would say on the deck and the model, if you share anything on the front end, like Ryan said with the projections, just share kind of the summarized version, but really hold that kind of detailed version for presentation, and that'll drive.
Yeah, we like to call it different resolutions of your company's pitch. So it's like, the resolution in the elevator is 90 seconds of my company. Do not even talk about revenue. Just talk about market, product, why you're different, yada, yada. But often what we hear about decks is there's a leave behind, and then there's a like in person, where the deck that you use to pitch is going to be less text heavy, less specific, because this is you're going to speak to all that stuff, and you're going to feel the room, and you're going to talk to investors. But you might want a very similar looking deck that actually has some of the really impactful things that you said. That's a follow-up. That's a leave behind. So if a week from now, the investor's opening their email and looking through the things and responding to your follow-up, like, oh, what did that company do again? Oh, here's some crystallization of the things that excited me during that meeting. They're not obviously saying this in their own brain, but they're like, oh, I remember that claim that they made that was really interesting. Maybe this is worth a follow-up. And like increasing, you can think of closing the check as basically going from VHS resolution to like 8K resolution, because the money's in the bank and the terms are closed and the documents are signed.
I love that. I love that.
I'm going to try to remember that and steal it for myself in the future.
All right. So here we are in Forecaster. So of course, my model lives in Forecaster. It'd be shame on me if it didn't. So here we are. Now, I just want to say though that everything we're going to walk through here in Forecaster, it works exactly the same way if you decide to use Excel or Google Sheets. So it's the same flow, it's the same kind of purpose, all that kind of stuff. So no matter where your model lives, this is all going to be relevant to you. Just to give you some orientation though, for folks that haven't seen Forecaster, so we've got an assumptions section, which is where the model is like built and managed. And so that there's all these aspects of your company, right? Your people, are here, your revenue streams, how you're generating revenue, how you're acquiring customers, all those things are here. And then you've got your financials. So the output of any good financial model, income statement, balance sheet, cash flow statement, you want it monthly, here. So that's really important. But you also want to be able to zoom out annually. I want to be able to zoom out and tell people, here's how big this business can get, and so these are the same numbers that you guys saw in the pitch decks. You want to be able to zoom out, zoom in, so that's what we're looking for here. Now, when you walk an investor through a financial model, we'll talk a little bit about kind of how to do this, and then I'll kind of get into character here, and we'll do a piece of it. So you're basically trying to, answer questions, alleviate concerns with an investor, give the investor kind of trust and confidence that you understand the financial aspect of the business. And so what an investor cares about most, the vast majority of the time, an investor is concerned with revenue. So they're concerned with how do you acquire customers? How do you establish the business? How do you generate revenue? That's really where their concerns are typically. It's not usually as much of like the nitty gritty of your expense base or something like that. They're really concerned with revenue. So the first thing we're going to do for an investor is focus on revenue. We're going to walk them through, here's how we acquire customers. And I'll come back and do this in a minute, and then we're going to walk them through, like, here's how we turn those customers into dollars. Like, here are our revenue streams. Here's where we are right now with revenue. Like, here are our near-term milestones. Like, by the end of the year, we want to be at close to 300,000 in monthly recurring revenue. So we're going to be focused on, how we generate revenue, our milestones for revenue, that kind of stuff, like what we think is important on the revenue side. So we're going to start with revenue because that's what an investor cares about. That's where most of the discussion is going to be. Once we get through revenue, then there's this natural progression where we say, okay, cool. Yeah, that's a really exciting revenue for the forecast for the company. These are the milestones we want to hit with this $8 million Series A or this $1 million seed or whatever it is. In order to hit those revenue milestones, though, we need resources. So we're going to naturally take a second step into our use of funds. So we would hit on kind of the people and say, here are the people that we need to hire over the next, 12 to 24 months to deliver on this revenue forecast. Like, we need account executives to sell the deal. We need financial analysts to help onboard our customers, right? So you're going to be hitting on some of the people that you need to hire and when, some of the other expenses. So you may be in the sales and marketing section talking about how you're going to be acquiring customers and spending on that. But you're just going to go from revenue milestones and revenue engine to use of funds and how the resources you need to achieve it, and then once you've gone through the use of funds, then you're going to essentially zoom out and talk about the investment. So that's when you might go to the financials. You might go to, an annual view here, and you may start to talk with the investor about, hey, like, and this is how we view the business long term. We already went through our milestones in the short run. We already went through like how we're going to spend the capital to get there. If we take that and we extrapolate it out, here's how big the company can get at scale and how meaningful it is and everything. And that's why we're raising an $8 million Series A. It's really to take this company to the next level. It's to hit, these milestones and position the company well for a Series B or for profitability or for, whatever it is your goals are. And so you're ending the walkthrough focused on what you care about, which is the investment, which is kind of the task at hand, and having a conversation with the investor about, like, what their concerns are or where they're at as far as making an investment, and having a conversation about what that next step could look like. So we'll come back to that as well. But that is kind of the story arc, if you will, is like start with revenue, because that's what the investor cares about. Kind of go to the use of funds, because that's a good thing to talk about as in the context of the next round, and then end with kind of looking at the big picture and talking about the round that you need to support that big picture, and ultimately crystallizing kind of a next step or trying to get them to make an investment decision. Now, as far as going through each piece of that, when you go through the revenue section, and that's by far the most important, kind of section to go through. I'll do it like for customer acquisition here, and then you can kind of rinse and repeat a similar process for the rest of it. So if I was to, let's say, like present to you all as an investor, and I'm walking you through the model, it might look a little bit like this. I might say, well, first of all, thanks so much for spending some time with me just to kind of sit down and go through this model. Like, we put a lot of thought into this financial model, and like we've really thought about like kind of the how our business is going to scale, and we really use this model to run our business. It's kind of a living, breathing model, and we update it regularly. So the first thing I want to go through is customer acquisition, because I think ultimately this company is going to succeed or not based on our ability to drive revenue, and that starts with driving customers. And we put a lot of thought into how we're going to acquire customers. So I want to walk you through that. If we kind of scroll down here and look at, the assumptions we're making around customer acquisition, it is a diversified approach. And you can see here in gray, like we've been tracking our customer acquisition by channel for quite some time. So we've got a pretty good idea of what our biggest channels are and what's really worked for us historically on customer acquisition. We currently acquire about 60 new customers a month, up from a little bit more than 30 about 6 months ago. So we've been having some good pacing, on that. If we zoom out though, I'd like to just kind of show you like kind of what some of the biggest bets we're making are. And so, some of the most important channels, like for example, our largest channel long-term and our largest channel in 2022 as well, is strategic networks. One of the big bets we place is that, early stage founders really kind of, congregate into communities. And if we can add value as a subject matter expert on financial modeling, we can ultimately become the financial modeling solution for a lot of these companies. And so we focus a lot on just providing real value in the form of expertise, to networks like Techstars, to networks like us. But like, so that's something that's really important for our company. So I talk about that, I talk about, and referrals and say, hey, we do a lot of things with customer referrals, customers talk, and investors ultimately make a lot of referrals for our company. So that's really important. And then things like kind of domain authority. So really driving Google SEO, written content, webinar content. It's really important that we provide education to the market and ultimately establish ourselves as kind of a thought leader in this space. And so that's really the way that we drive customer acquisition. What questions do you have about how we acquire customers, or could we move on to how we monetize? I'd be happy to kind of flip over to the revenue stream side and talk a little bit about, monetization. So kind of press pause on that, right? So like what I'm doing there is I'm not going, really deep into the weeds of how each one of these channels work, of the specific assumptions I'm making about any one of them. I'm not going very deep at all, really. I'm just kind of, what did I do? I talked about kind of what goes into this model, how we use it. I talk about where we're at right now from a customer acquisition standpoint, and then what channels are the biggest, what are the biggest bets that we're placing. And so it's really kind of a high level strategic overview. And that's really what you want to do, is like start with a high level strategic overview like that on customer acquisition. You're specifically wanting to kind of answer the question of like, it's the first section. So you kind of talk about how, where the model's coming from, how you're thinking about it, how you're using it, where you're at right now with customer acquisition, which I have real numbers. Like if you were just getting at the start, you would say something different. You might say, hey, we're pre-launch at this point, so we haven't started acquiring customers. So, obviously, we're kind of at the starting gate here, but we put a lot of thought into how this is going to work. We've seen how pure companies do it, and these are our thoughts on customer acquisitions. Like you may start, a little bit differently, but talk about kind of where you are right now, and then what are the key kind of messages you want to send on customer acquisition? What are the key things kind of that you think they need to have conviction about if they're going to invest in the company? So start with that, and then open it up for conversation, and that's the most important piece. You don't want to talk at them too much. You want to just give them a high level overview and then open it up for conversation, because they may not have any questions about customer acquisition. Like if you've been acquiring customers and it's been working and they've been seeing it and they understand this piece of the model and they're like, you know what, look, like I really honestly don't doubt that you can acquire customers. I'm more curious about kind of how you monetize them and what the lifetime value is, because I think there's concerns there. Then like, cool, like you just start with that overview and then you're going to switch over to revenue and you're going to dig into that. Conversely, you may get a lot of questions about customer acquisition. They may ask, like they ask us, like, how do these strategic networks work? Like, do you have exclusive agreements? Like, what's the deal there? Like, what are your underlying assumptions for how that scales? And how deep do you think that well is? Or what makes you think that you have these kind of viral loops with investors? Help me understand that piece, because I see you haven't like driven a ton of that in the past. Like, and so you'll see what their questions are, but the point is you open it up for the conversation, you get their questions, you hear their concerns. That allows you to dig deeper and alleviate those concerns, answer those questions, and also kind of gives them a preview into like what life would be like with you as a portfolio company. You're having a conversation, you're talking about the business. It's in my mind, it's no different than a pitch deck, right? In a pitch, what do you want to do? You want to hit the highlights as a strategic overview and then open it up for Q&A and discussion, and use the pitch deck as essentially like an aid to having a strategic discussion about the company. The model is actually the exact same thing. You're using the model to do that very same thing. So you're having that kind of discussion about customer acquisition, and then you're rinse and repeating. You're switching over to revenue. You're digging into how the company is generating revenue, maybe where you're at right now with revenue and your recent history. What your milestones are for the next 12 months, or 18 months with the money, how far you think it can get for you. You may zoom out on revenue. You may say, like, for example, for us right now, we have about a 60-40 split on annual subscriptions versus, services and support. If I zoom out, we'll see that split becomes different. It's more like 80-20. So I might talk about that and how our business evolves over time. So, but you're similar deal, you're talking about kind of how you're monetizing the customer. You're talking about where you're at right now, your near-term milestones, how that's going to change as the company scales. And then you're opening it up for questions and concerns, whether those be about the structure of your revenue, the margins of your revenue, the unit economics, maybe things like churn or price. That you'll get a kind of everybody will get different questions based on the investor, based on the nature of your business, et cetera. But you're doing that same thing, right? You're kind of starting with that overview, then you're opening it up, you're having those discussions. And then once they really once they get comfortable, once you get through the revenue side of the house, which in my experience is where most of the questions land, is like between customer acquisition and revenue, then you're going to keep working your way down. Not all the way down typically. And like if you have like a complicated balance sheet, like maybe you're kind of a physical goods company and you want to talk a little bit about your inventory or things like that, you could. But I think other than just revenue, a lot of times it really kind of hinges on people. Like, who are the people that you need to hire and when to achieve your goals, and what are the skill gaps maybe you need to fill, or what I like to talk about a lot is like the kind of the roles that you need to hire a lot of. So like one of the things we do a lot in Forecasters, we do something called modeled hires, where you can link people to your growth. And so those people get hired automatically based on the structure of the company. And those are just great things to call out for investors, so they have confidence that your model is going to kind of stay in line with the business as it scales. And, because a lot of models, sometimes the revenue just keeps growing, but the people doesn't really grow. And so then it just kind of like becomes a cash machine. Yeah. So that's a great thing to talk about. But, but with every investor, you kind of have to be flexible. Like some people are going to want to go deep on people. Some people are going to be just kind of cool with it as is. But then you're going to so you're just going to go through those conversations as much as they like, but do watch the clock. Like, do make sure you're doing kind of time management on it, because let's say if you got 45 minutes and you spend the first 30 minutes really digging into revenue, which I wouldn't be surprised at all, then you want to make sure you have enough time to like get to financials at the end, to do that zoom out and kind of show them, hey, like, here's how big this business gets at scale. And we're here to talk about an investment opportunity, and we're raising an $8 million Series A. We'd love to have you in and leave the round. We think you could be a great partner for us. Like, I hope I was able to show you today, just how much we've put into this business. Like we really understand this business, and I think we're ready to scale it. Like, give me a sense of your take. Like what remaining concerns do you have about the company? I'd love to talk about those. Or what do you think a good next step is? Would love to do, would love to have you meet my co-founder, or love to, continue this conversation. So let's talk about that, and make sure you have room for that conversation at the end, so that you don't run into the end of the meeting and have to jump quick. And so you make sure you actually have a next step identified, before you get off the call. So.
And I think that whole section highlights a way to kind of, one, combat the exhaustion of fundraising and actually improve your company while feeling like you're disconnected and away from it. Like Steven said, he's out west for 6 weeks, maybe
Yep.
8, 2 weeks into an 8-week kind of thing.
Yep.
This is his full-time job right now, is basically pitching and fundraising. And if you guys are in the founder curriculum, we're actually doing a session tomorrow with HubSpot all about the tactics and operations of running a fundraising and how it does become a C-levels person's full-time job. Usually the CEO is gone when they're fundraising because there's so many meetings to do. And if you think about it, it's like the percentage, the money, the number game of fundraising is like, you're going to pitch, I don't know, 20 times, before you get one person who's actually somewhat committed to it. Maybe that might be actually a little optimistic. It could be, 50 times for every check that gets written. And that can feel exhausting, intimidating. And it's like, if I just say the same thing over and over, am I going to just, like, my brain's going to fall out of my head? It's like, be active in that process, because you can improve your company. When you go and talk to that one investor who wants to deep dive on unit economics, or says, hey, this customer, I've seen companies like this before, scaling customer support like that doesn't work. It's going to be twice as much. Don't be like, great, 2x it, now that's our new model, but be like, oh, great, let's take your concerns, let's stimulate that out. Hey, look, we're still profitable and we're still venture scale even with that, but also taking it back to your team, having the pitching feedback be a constant funnel back to the team to be like, this is what the market's saying. These are what investors are concerned about. Once, twice, 3 times somebody has brought up that this just seems unrealistic based on their other companies and their portfolios. That's like gold for refining both your future pitches to few investors and your business model in general. It can literally help you level set, gut check, and build that flexibility into your ongoing model.
Yeah, I think that's a great point. And I mean, I'm living and breathing that process right now. Like, I mean, I'm in that start of week 3 of my process. I've had 30 meetings so far. I've gotten 12 no's so far, but I've had 8 kind of folks move on to a second meeting, but then there's a bunch of people that are still deliberating. So I think we'll get a bunch more no's. So like Ryan said, it is a funnel. Like, I mean, you're going to get a lot of people, get 2/3 of people probably on that first meeting that are gonna just straight up say no. Maybe you get 1/3 of them that kind of take you up on a second meeting, like a model walkthrough, and then probably half of them or more will say no. And so it is really something where you need a lot of at bats. You got to run the numbers game. You got to have thick skin, and it does take pretty much all your time. So let's get into some questions. Let me just kind of say one more piece here, and then I want to open it up for questions and really, yeah. So just last thing on us, basically on Forecaster. If you like Forecaster and you're interested in it, I think Calvin already shared this, but we'd love to consider working with you. And obviously, like, we just love to work with you. I guess we'd love for you to consider working with us, I guess would be the better way to say it. We offer 25% off our annual subscription to anybody that comes to us through Gus, and we love working with Gus. And we do a 30-day white glove onboarding with an expert analyst. So I think it's a great way to make sure you get a great model. Something I also would love for Calvin to share is if you don't feel like you're ready to work with Forecaster, you're not interested for any reason, we also have some really awesome financial modeling templates, like just templates that you can rip off the shelf to really just get started in a way that's completely no cost. And I think that's a great way to consider kind of getting going as well. So if you're more comfortable with something like that, I encourage you to kind of check out our templates. I want to be very careful to say that you do need to kind of get in there and massage them to customize them to your business, but it can help kind of kickstart the process and stuff like that with you. So, that's also something that we'd love to, offer to you if that's interesting. But yeah, I know we got a bunch of questions, so let's do it.
Let's do it. All right. We got Skylar. Hey, Skylar, I've seen you at a number of events. So the first meeting, you don't want to leave with your financials, but what if they're asking for them after the second or the third? Appropriate? Seems like we answered it.
Yeah, totally. I mean, I'd say you don't lead with the financials, but if they ask you financials, I think you should be prepared to jump in. That's where I like to be as a founder with a lot of things. It's like I'm ready to go deep basically in any aspect of the company. I'm going to lead with the stuff that I think's the best for converting, which is like vision, proof of execution, key strategic bets, why we're going to win. But then you ask me a question about financials, I'm ready to go deep. You ask me a question about product velocity, I'm ready to go deep. So I think, yeah.
Yeah, I think I've said this many times before, but startup world is generally like little tiny little signals, little by little, and then all at once. Things generally follow an avalanche model rather than like an erosion model in startups. So be sure that you're ready for the avalanche, because you're going to have to be it. No investor is going to be like, I love your idea so much, I'm going to go get 7 of my friends and we're going to lead around and we're going to set your terms and the financial model is going to be like perfect. No way. But if you can say immediately, here's the next step, that's great. All right, we got Jamie Wood. They got 3 revenue streams. Oh, this is a great kind of forecaster question. How do you suggest presenting when it's not just like one stream of revenue coming in? Like later on, you're going to introduce new ones. How do you put that in your model, both with forecaster and in your conceptually?
Yeah, totally. So it's all about kind of the narrative and telling that story. I'll use a good example for us here at Forecaster. So, if I'm walking through our financial model, you can see right now, kind of historically, we've had like a one size fits all pricing, standing the company up, typically $2,000 a year, 25% off for you. Now, as the company grows, like we're now moving into a variable pricing model that prices along with your operating expenses, and it scales along with the company. So that way we can offer like kind of deep discounts to companies that are early in their life cycle, but as companies grow, they can kind of earn into the product. So that's a model that we're launching, basically right now. And so we talk a little bit about that. Down the road, as we mature the value of Forecaster, we get into selling larger companies, enterprise pricing, custom pricing. And so you're talking about kind of strategically how things change over time. And so in your model, those things should be represented. And like using something like Forecaster, you can kind of pluck stuff from a shelf, mix and match, build custom formulas, that kind of stuff. In an Excel model, you do the same thing. You'd kind of configure those things yourself, and then just in your story, as you're telling them about your business, you should talk about the future state, and you should talk about how your business evolves and improves over time, how your business gets even better over time as you layer in these different revenue streams, and they all kind of compound to maximize lifetime value and that kind of thing.
Perfect. Anthony Thompson asks, how do you make projections if your company will be the first? Oh, we get this a lot. Innovative companies producing, machines or devices or just something that has no competitors or has no preface. That like, how do you point to something in the space? How do you price it? How do you model out the future?
Yeah, it's a great question. So what I'll say with this one is like, I think that the key piece, and this goes for anybody, even if you're doing something that is more kind of down the fairway, I guess, so to speak, is just really making sure that like first you just build a financial model based on your own assumptions about the business, which could be wrong, right? Like you have to just kind of start somewhere, and you have to say, hey, based on our experience, based on what we've seen, this is what we think is reasonable. I don't think you should let yourself live in that vacuum, though. I think like go to your current investors, go to your advisors, go to your founder friends, and talk to them and say, hey, this is kind of the forecast. These are the assumptions I'm making about the business. What do you think? Does this sound reasonable to you? Does this seem attractive to you? Like attractive and reasonable, which is what you're trying to get to with the output, is a subjective thing. So work your network to try to get a sense of what is fair and reasonable. Because I'm assuming, because there's no data out there like publicly about this stuff. And then like you should be upfront with that with investors, because investors are a lot less worried about like exactly what the output of your model is. They're much more worried about your input and like what kind of critical thought have you put into this thing. So if you're doing something new, you may say, look, we're at the starting gate here. We're doing something brand new. So I think as well as I, Miss Investor, that like there's a lot of unknowns here, but we've spent a lot of time thinking about this business. We've been in this space for a while. Here are the assumptions we're making about customer acquisition. Here are the assumptions that we're making about revenue and pricing. Now, as we scale this business, we'll continue to revisit those assumptions as we see what the market will bear. We'll be updating this model, but we fundamentally believe that these assumptions are fair and reasonable right now. And then so you just kind of say something like that, and that's the truth, and every legitimate investor should recognize that, should understand that, and you just talk them through those assumptions, and you're kind of building trust and building confidence, in just having a frank conversation about the fact that there are unknowns with the business.
Yeah. Do you have a hard stop at the top of the hour?
No, I don't.
Okay. Well, do you have maybe 5 minutes to get to a couple additional questions?
Totally.
Because I will refrain from providing my own insight for the sake of time. But this question always comes up. And one of my favorite examples about this is why financial modeling is worth doing, even if you're pre-product or you're pre-whatever, is you get to see when your disruptive, innovative vision starts to bang up against reality, even in the best of scenarios. So when you drag things to the right and you look out to 2027 and you say, oh, we're going to be a $500 million company if everything goes well, and that says you need 3 billion customers, you can sit there and look at it and be like, that's probably impossible. Like getting half of the planet to use my software, including babies and geriatrics and everybody in between, is very unlikely to be a go-to-market strategy. So you can step backwards from the ridiculous and actually put together something that can pass a test. You can look at companies all over the place. Few companies have more than 20% market share in a huge amount of markets. There's some Goliaths, certainly, but all over the place, you can really start to level set. Even if your idea is brand new, you've never seen anybody like it. It's a really good way to bring the visionary down to the real, because investment happens somewhere in between those. Here's a great one for both forecaster functionality and just strategic strategy. Aaron asks, should founders have multiple versions of the model? Conservative, realistic, aggressive, things like that.
Yeah, 100%. So we adopt the philosophy of like, you should have conviction about your plan. So if you notice mine, like I've got a Series A model. This is the model I walk through it with investors. It is our Series A plan. So like I'm providing conviction to the investor that this is the plan. This is what's going to happen. Now I have other scenarios as well. I've got a goal scenario for Q1 of 2023 that we've used to set our growth targets for Q1 with the team. I've then got an active model here, which we manage on a month-to-month, week-to-week, like day-to-day. Anything happens, like we just immediately spot update it, because this is our cash flow scenario, this is our accountability goal scenario, and this is our investor scenario. And if I need to create another scenario, I can clone the model. I can create another version. Now you can do the same thing in Excel or Google Sheets. You can save a copy, right, and manipulate it. So I do think you should absolutely have different versions of the model, both for your own self, for kind of thinking about cash, thinking about growth, and for the investor. And I think you should be willing to make adjustments as well. Like for example, us, we're raising 8 million. But if there's appetite from a smaller investor, maybe to lead a $6 million round, like we know that the model says we need 5.5 million to get it done. So 6 million would work for us. And like, as my lead investor, tells me, is like, you're in the yes business when you're fundraising. Like until you get a term sheet, you're in the yes business. So now, if there's something that like a $4 million round for us wouldn't work, so I'd have to say no. But if 6 million is a round that works, even though I want 8, I'm in the yes business. So I'm saying, hey, if you want to lead a 6, I'll explore that with you. I'll see what that looks like for you. And I wouldn't be able to explore that with confidence if I hadn't run some scenarios to understand kind of what are the bounds of what will make sense for us. So I do think it makes sense to have those different scenarios.
Totally. And I mean, we'll do an event on this probably next week, but to run your business day to day outside of fundraising, using a financial model with various scenarios allows you to react month to month, day to day with how things go, because macroeconomic environments change. 2023 and 2022 turned out to be a lot different than the decade before it. So being able to be like, I think Steven even mentioned it before, he's like, there is a get to profitability version of this. Should everything just go sideways for whatever reason, completely outside of our control or our ability to execute, the world shifts and changes. Like you can actually have some confidence in what you would do rather than just being like, wow, I really hope this closes. If it doesn't, we're going to go into panic mode and figure out something. Sarosh asked a question, which I think we already answered, was like, yes, you totally include future products and add-ons when you're doing modeling, and actually even when they're introduced, which helps you set deadlines with your team. Bridget, okay, so yeah, I was probably not too clear on this, is asking if you're emailing a pitch deck in, or you're submitting, like you're using Gust and you're submitting to angel groups, which will ask for like business details and pitch. We are suggesting to not put your detailed financial model in that. You can put some high level projections, usually just annualized for the year. And it's literally just kind of like revenue driver, expenses, break even, whatever. But don't put the kind of stuff that we're seeing here today, which breaks it down by product line with hiring plans, with acquisitions and revenue streams or anything like that. Itis actually asked a cool question that's getting some engagement in the chat, which is they've got angel groups ready to write low to mid 6-figure checks, but all of them are saying if we find a lead investor, which is fascinating. What's the best way to find a lead investor? Somebody who just mentioned that he had a lead investor.
Yep. Best way to get a lead investor. Couple different things here. So depends on kind of the size and stature of the rounds. I'll talk about that. So if you're doing kind of a smaller round, like maybe a pre-seed or a smaller seed round, even where maybe a VC isn't going to necessarily step in and write a term sheet, like you can have a lead investor when you're doing an angel round, a friends and family round, et cetera. And the best way to kind of identify that is like, hey, you're pitching investors and kind of running a process, but you're trying to find people that are perhaps your more sophisticated investors or more seasoned investors, more experienced investors who have kind of a deeper pedigree or will write a larger check. And all a lead investor means is like someone who's willing to set a price and set terms on the round. That's what a lead investor is someone who comes in and works with you to say, hey, here's the price, here's the structure, here's the terms. You're setting that with them and then shopping those around to everyone else collecting their investment in on those terms. And so you can work like an angel could be a lead investor in an early round. So you just like, as you're kind of presenting to investors and as you're garnering interest for the company, you should just be kind of thinking about, folks that may or may not be willing to lead. And you can ask them that question. So you can say, we don't have terms set for the round. We're looking to kind of work with, with a few investors or one investor to really, kind of catalyze the round. We'd love to work with you. We think you're a great investor. We'd love to work with you to find terms. So you may do that for kind of the early angel rounds. And so if you're raising like a pre-seed or something, that's something that you could consider. Largely though, lead investors for like seed or Series A rounds are institutional VC investors who are going to come in and give you a term sheet. And those are investors that kind of pre-qualify themselves. And so typically in my experience, like these VCs will say, hey, we like to lead rounds, in the seed round or Series A round. And so as you're having conversations with investors, before fundraising and when you're fundraising, you should be asking those questions. So like, how do you like to participate in seed or Series A rounds? What's your average check size? Investors will say, well, we like to lead or co-lead rounds of, 1 to 5 million. We typically write, a $500K to $2 million check or whatever it is. So you're getting that information and then you're running the process with the lead, and the difference being that the lead, then when you run the process with them, they won't kind of, they won't make these commitments that are contingent upon a lead. Their commitment will usually come in the form of, here's a term sheet where we're going to do $1 million on your $2.5 million seed round at a 10 million post, which is what was the case for us. So.
And they also has to follow up, like if we do intros, either Gust or Forecaster, neither of us have intros as a service. But I would say you're sniffing around in the right places. Like if you're getting interest from angel groups in the 6 figures, and Aaron actually supplies some Q&A answer. I don't think it's in the chat, so you might not be able to see it, Itis, but it mirrored a lot of what Steven said is if somebody says they're willing to write $500,000 check, ask them what it would take for them to be a lead if that's coming out of an organization. And how they want to do their deals and like what the term sheets that they're generally comfortable writing. And for looking them, it already sounds like you're applying to angel groups. You can find lead investors through members of the group. Angel groups invest in many different ways. Some of them raise a fund where all the members put money into the fund and then the fund chooses to invest. Other people, it's like a loose collection of people who just meet on a regular process, but the individuals are the ones writing the check. So often you might be pitching a group, and there's 50 people at this meeting, but the lead is going to be one individual who's going to walk away being like, hey, I've got domain experience in that thing. I really understand the market here. This really fits my portfolio, and engaging those individuals can help generate a lead too. Often knowing that a lead investor is somebody who needs to have the capacity to do their side of the equation. So often they will have counsel that helps with the term sheets and the negotiation. If this is a later stage round, something beyond, it's usually a priced round, but it could be something in convertible note. But for finding them is use gus.com/search. We've got tons of angel groups out there, that are actively writing checks, even in downturns and things like that. And then just get out to industry events. Angels and VCs show up all over the place. If you're near any metropolitan area, you can probably find 10 events this week where people will be around. And It does require a little bit of networking and serendipity, but it's definitely possible. Oh, good. Thank you. And we're getting some validation that was a helpful answer. Thank you, Stephen. And Mutessim asks, oh, this is great for Forecaster. What if your revenue is based on advertisements, not SaaS necessarily? How would you model that kind of revenue?
Yeah, totally. So, the answer kind of in general is when you're modeling revenue, you always have to just kind of think about, well, how does it work? And so you just have to logically go through it, where if you're doing ads-based revenue, then you may try to figure out, okay, well, how does my funnel work to acquire customers? So like what channels am I using to drive, users or customers or traffic or whatever that is for you. So you kind of think through how those funnels work and describe those, and then on the revenue side, you'd be saying, okay, well, maybe what are my ads based on? Are they based on page views? Okay. And so then is it users that have page views, and like, what is the average page view per user? And then what is the average ad like revenue per page view? So I do kind of users, and then I have like an input like page views for user, and then that gives me page views, and then ad revenue per page view, and then that gives me revenue. Right, so I'm thinking logically about kind of how it goes. In Forecaster, you've got the ability to kind of build all this stuff out, so you can build customer acquisition streams and funnels of different shapes and sizes that kind of come out of the box, which help you just get started. And then we should probably add it, honestly. We don't have advertising revenue directly out of the box here, but it's something you can easily build. And when you do, you'll end up with something that kind of looks like this, where you've got some metrics, but your metrics, instead of like annual price, which you can manipulate, might be like page views per user. And then you're like keying that in and saying, how that works. And so hopefully that makes sense. But just kind of generally, you're just kind of thinking about like, how does that revenue actually work? Like, what is the formula for that revenue? What are the driving metrics of it? And then you're making assumptions about those metrics.
Yeah. And one thing we can finally confidently say, hundreds of customers in, it's like we've never seen business models that cannot be forecasted. A lot of times it seems like, oh, it's a physical product. Oh, it relies on a two-sided marketplace. Oh, it relies on like a constellation of people coming together and like doing whatever. But at the end of the day, the fundamentals usually means it can be modeled. And I think one of the benefits of Forecaster over a spreadsheet, having been someone myself who's made a lot of financial models and spreadsheets, is those underlying assumptions and smart defaults, where if you're like, oh, I'm doing a subscription-based thing, they point out all the things that you might not have thought to add a row for, or like a depreciation or an appreciation or a cost section, where it's like, if you're adding a subscription, it's like, well, you have to figure what is churn, what is renewal, like, is there, multiple tiers and things like that. And having those kind of more than just a spreadsheet sell, which would require you having done enough of these that you realize like, oh, anytime I sell something with subscriptions, I need to account for churn. Anytime I sell a physical product by the unit, I need to account for cost of goods sold. Really, really helps having that. I mean, this is the spiritual alignment with Gust. We think the same thing with corporate back office and governance, which is like putting that smart information there at the time that you're asking the question or doing the transaction is far more valuable than being like, yeah, you could go download a bunch of legal templates from a variety of places and sign them and, run your corporate office. But unless it's all kind of harmonizing together, you often miss some very important assumptions that won't really come to bite you for months, if not years at a time.
Yeah, 100%. And that's also for us, it was where like our kind of white glove onboarding really comes in handy as well. Like we've got a team of expert analysts that like are trained to build custom financial models for startup companies. So they kind of really help you really, kind of turn all your ideas about your company into a revenue formula that is forecastable,
Yeah.
which is
that can be your when you start doing what are they called, conferences. Forecastable could be up there as a conference name. We got a couple of questions. One I think you highlighted on right here, which we definitely want to mention, is the white glove onboarding and the 25% discount is all through the Gust link, and they will help you with those kind of questions. So like, oh, I'm an advertising based model. They know exactly what that means and how to set it up, and they will actually build the model with you. So you don't have to go through every checkbox and thing. The bigger value of it right now is that once the living and breathing model is up, you can ask questions to it. You can run scenarios on it. You can tweak some things and see how it changes the future and what you need to get in shape. And that is included, I believe it was the 30-day white glove with support and the whole thing linking into you to both confirm that, Stephen, but also what is the cost, both rack rate and with us?
Yeah, totally. So all that onboarding is all kind of included in our base package, and Forecaster kind of out of the box is typically $2,000 a year as an annual subscription that's paid up front. That covers that onboarding. There is a 30-day money back guarantee. If for any reason you're unhappy or your business can't fit into Forecast, it doesn't happen often, but we just, we believe a lot in making sure that people are really happy with what they get. So for any reason, you can always get that back. But $2,000 a year is our standard rate, and then guest companies get 25% off in the first year. So it's $1,500, which gets you 12 months of Forecaster and 30-day white glove onboarding.
Awesome. All right. Well, just 10 minutes over. Thank you for hanging out a little bit longer with me. I think that hits all the questions. Fantastic. So we will send out follow-ups. We'll send out the recording, the links to the discounts and whatnot. It's not like, it's going to expire by the time I click the end webinar button here, but all the information will be in there. Be on the lookout for other stuff. This was, like I said, part of kind of the founder series that we're doing all around like launching a company, being prepared to really give a good go at it. We've got some more programming all week. I will be hoarse by the end of the week, I'm pretty sure. So we'll Steven with both fundraising and demos, but keep an eye on your email for future events. And we will always do more programming with Forecaster about similar principles, but using them in other parts of your business, how to run day-to-day operations, like I mentioned earlier in the thing, and even how to do 0 to 1 with your financial modeling. So if this stuff's appealing to you, you're not there yet, you don't have a model, keep a lookout in your calendar. We'll do some more. And I think we're doing some more creative events coming up soon. We had a great pitch deck teardown at the end of the year, honestly, like the day before Christmas, and we had hundreds of people show up. So I'm pretty sure we'll do something like that again. That was super educational and very community. It felt very communal. So yeah, any parting words, Steven?
Just a deep appreciation. I really appreciate everybody, participating today. I really hope I was able to add some value, and then obviously I appreciate you, Ryan. We really appreciate the work that you guys are doing at Gus. I think you guys are doing phenomenal work, and Gus Launch is an awesome product, and the work you guys do is just, it's great for the ecosystem. So yeah, thanks for doing what you do, and thanks for letting us be a part of it.
Yeah, we all love it. Have a great week, everybody.
Later.